Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is a weekly technical analysis of Paris milling wheat and London UK feed wheat. I'll start with Paris milling wheat. There have been two main bullish Andrews pitchforks that have worked here on this market. There is the original late March, early June action, and until late November we also had the early July to mid-September one. Both these were crucial in the running of the market and to the overall bullish incentive, but on the Monday 2 weeks ago, the early July to mid-September one was broken when prices punched down through the lower time, currently at 319.5, and then cemented the move lower the next day by gapping lower still. This pitchfork will now be retired after this commentary. There's left the original late March to early July bullish Andrews pitchfork as still the main avenue for the bullish incentive. The market eventually broke down through the middle time of this pitchfork, currently at 265.5 last week, followed by the combination of the rising short medium moving average, currently 282.75, and a 2012 high at 279.25. However, the fall hesitated yesterday and today, and I think I know the reason why. We have a defense in depth strategy here for any attempts by the market to head lower. Firstly, we have a concentrated congestion between 265.75 and 269.5. At the same time, we have the rising lower time of the bullish Andrews pitchfork, currently at 265.5, which is inextricably entwined right now with the rising medium moving average, currently 265 even. Finally, we have two further bands of congestion below, between 250.5 and 255.75 and 237.75 to 244. All this seems a hell of a lot to take on right now, with just a market that is pulling back from a little to an excessive move higher. I suspect the attrition in these supports may well erode any new recently crafted bearish incentive. It is, as I've said now for many weeks. Please continue to keep in mind the bullish March to July Andrews pitchfork is still very much intact, and until that is broken, redesigned or reassigned, then it will rule the overall bullish incentive. Plus, this is all taking place in the shadow of July's monthly key reversal up. London UK feed wheat. So I'm still using a line chart for most of the action here. That's okay, it helps with the patterns. Anyway, the current move higher can be traced to the market stabilizing just under the then short medium moving average, currently 216.70, and amid the undergrowth of lesser Fibonacci levels at 183.45, 182.20 and 181.60. That was seen back in September. The rise was somewhat spectacular and uncalled for as the market made 3 gaps within 2 weeks. Notably the long move within 2 weeks, and yet still continues to move higher, up through the various resistances, notably the long moving average, currently at 199.20, before an even stronger kick upwards pushed prices up over the old March 2013 high at 205.05. This caused yet a further attack higher that finally cracked the March 2013 high at the 2013 high at 215 even. 11 weeks ago, I said, and I quote, "All this action has allowed me to draw a July to September bullish Andrews pitchfork, and it is the lower time of this pitchfork, currently at 238.5, that has recently shown the bullish angle of attack. Thus, the middle time above, currently at 255.10, is the main rising bullish resistance beyond the March 2013 high." It is, as I've said elsewhere, until this bullish Andrews pitchfork is broken, changed to a bullish shift pitchfork, or reassigned and retired into something else, then it will drive the bullish incentive higher in this market. And that's the end of the quote. Okay, so we now come to 3 weeks ago when the market's rise finally stalled and prices dropped back down below the lower time of the bullish Andrews pitchfork. And for the first time since early September, the market looked like it may have done enough on the upside. The reason for this apparent change? Well, I put it down to achieving target X back in late October. Now, I previously detailed Target X some 9 weeks ago, and I quote, "One final thing to add, and I've expressed this last week here and elsewhere in some of the other grain markets, which should have shown a similar aptitude. It is to look at the July to date action as a bullish halfway hesitation type pattern. With this in mind, I had previously placed the prospective Target X in the 213.15 area. This is not as insurmountable a target as elsewhere, but let's not kid ourselves. It is still a big ask," and I've not altered it a bit from last week. And that's the end of the quote. Well, this big ask became a big reality in late October. However, the prices did not stabilize there. Instead, it seems to have prompted some insecurity, causing a further rise higher before a drop down 2 weeks ago, down through the lower time. This was confirmed last week. This week, prices hesitated a little, as if unhappy being below the congestion at 225 or the 212 high at 227.15, before finally dropping down through what was and is a fairly clear area down to the combination of the congestion at 217 even and the rising short medium moving average, currently 216.70. These are the first supports of note below the 212 high. Now, previously I had been tempted to draw a shallower bullish shift pitchfork for the same action as the Andrews. However, looking again, I am not comfortable with doing that, as the peak we saw in November had already ruptured this pitchfork. Whatever you may think, one thing is for sure: the bullish Andrews pitchfork will be retired after this commentary, and it is now also time to look at further supports below and beyond the short medium moving average. Now, we do have some significant previous support from the 2013 high at 215 even, but I suspect you would also have to look at where the rising medium moving average resides, currently at 205.20, as we have the March 2013 high there at 205.05 as well. If this doesn't work, then we may have the 50% Fibonacci line below that at 201.35 and 199.90. We have actually a couple of them there, plus the slowly rising long moving average, currently 199.30. All these look pretty formidable right now, so it would not be the end of the world if we saw prices fall back higher, or pull back higher I should say, from current levels. But as for now, as for how far higher, well, that bit I'm still not sure about. There's one final point, and the reason why it would not surprise me to see a pullback higher. 3 weeks ago, we had a golden cross of the medium moving average crossing up over the rising long moving average. Now, this is a lagging indicator, but what I found most interesting was immediately following the golden cross, prices headed further lower. This may indicate a stronger bearish incentive than first imagined, so watch and see. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.